Hello, everyone. Today on the final bar, I'll be joined by Llanes from Wealthnet Investments. We'll talk about this overall market environment, sort of a choppy session for much of the day, but accelerating to the downside. We talk about risk on versus risk off. It's hard to experience a day like this and not think of it as anything other than more of a risk off move. The S&P down 1%, consumer staples and utilities, the only two S&P sectors in the green. Everything else feeling the way today. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we focus on the market environment using the power of stock charts, using data visualization techniques and the technical analysis toolkit to better understand the message of price and trend and momentum. You know, this week has certainly been a choppy week among choppy weeks year to date. It's been a difficult run so far for the S&P. You know, really pushing up to 4,800 in November into December, but now January feeling, more weaker rather than stronger, more selling pressure than buying power. And today, I was sort of planning out the show. And again, I feel like I should have learned my lesson by now after a couple of years of doing the show by prepping too early, because the last 30 minutes tends to have these significant swings, and you're seeing some distribution into the close, similar to what we saw yesterday, but today really undercutting the lows from earlier in the week. The S&P closing below 45.50, and we've talked about that as the line in the sand for quite some time. As long as 45.50 holds, overall, arguably, the trend is still fairly constructive. Not the case as of today. So I think through the remainder of this week, it's all about follow through. Now that we have closed below a key support level, do we follow through? Do we break further down? Big earnings this week. And so we're going to talk about some of the financial firms that are reporting earnings. We'll look at some of the charts, how they've seen some gaps and really some distribution in the larger banks like Goldman, JP Morgan, and others, and what that means relative to the broader picture for stocks. A lot of great content on StockCharts TV. On this show, we have some great guests. I'm excited to talk to Llanes, who's joining us a little later in today's program. Tomorrow, we have Katie Stockton from Fairlead Strategies. And I'm excited next week on the 25th to welcome Chris Shavacco from Shavacco Capital at Atlanta, which does a great job for us. A couple other special events to highlight for you. On our ACP platform, which is part of your StockCharts subscription, we have a plugin store with some really great premium plugins from some third-party contributors that do a really good job of helping give some additional ways to visualize the markets. The guys at Go No Go Charts, Alex Cole and Tyler Wood, are joining. Actually, just implemented a plugin on StockCharts ACP at the end of last year. We are launching their new show, the Go No Go Show, this month on StockCharts TV. We recorded a special conversation with them. Our Grayson Rose sat down with Alex and Tyler. That'll be airing on the 24th, which I think is Monday of next week. Also, next week on the 26th, we have our latest episode of The Pitch. That's where we bring together 3 expert strategists, all pitching you 5 ideas, stocks, ETFs, whatever is top of mind for them. I will be sitting down with Jay Woods, Chief Market Strategist at Drive Wealth, Joe Rabel, founder of Rabel Stock Research, and Mary Ellen McGonigal, President of MEM Investment Research. Should be a lot of fun. You will leave that episode of The Pitch with some tickers jotted down to dig into a little further. Go to stockcharts.com/thepitch for more info and also to see all of our previous episodes with some great insights. Let's continue on today's show with our market recap. As I mentioned, it was a choppy day until the last hour and really the last 30 to 60 minutes, showing some distribution on the S&P. S&P closing below 45.50, which is significant. We'll get to a chart of the S&P here in a few moments. But the S&P, the Dow, both down 1%. The NASDAQ composite down just a little bit more than that, and mid caps and small caps really pushing even further to the downside, with the S&P 600 small cap index down 1.7%. The VIX is well above 20 now, nearing 24 today at the close. Bond markets coming up today, and this is sort of a flight to safety sort of feel with investors getting out of equities and getting into bonds, and interest rates coming off with the 10-year yield back down below 185, closing the day just below 183. Commodities, we see gold and silver, the precious metals, going higher, and that's been an interesting change from last year. Last year, at times when it felt like there could be a safe haven move and gold would actually start to do well, particularly given the concerns on inflation. You really didn't see that materialize. And really a big part of that is the dollar being so strong. This year, all of a sudden you have the dollar rotating a little more weaker relative to other currencies, relative to the euro and others. Gold having some room to move higher, and really one of the bright spots today with a lot of red on a lot of different asset classes. Gold and silver doing just fine. Commodities as a whole doing well as well, using the DBC. Cryptocurrencies continuing to weaken, and we've seen Ether and Bitcoin and the other major coins that I'm showing you on the screen here coming off of extreme high levels. Bitcoin, obviously coming down from, the upper 60,000s down to the lower 40,000s, but both of those have bounced off of key round numbers. Bitcoin off of 40,000, Ethereum out of 3,000, still remaining above those levels. I think those are important lines in the sand, important levels of support to continue to monitor, even though you have plenty of choppiness recently, and there's always volatility in crypto land, but especially recently as we're rotating around off of those key support levels. A daily chart of the S&P 500, as we look at it, we're looking at the last, basically the last 12 months or so, going back to December of 2020, and showing all of last year into the beginnings of this year, and again that 4550 level continues to be incredibly important. So that pink shaded area here, that's the resistance that we hit in September. That became the support that we bounced off of a number of times in December. Now we're once again getting below there. So a key level of support is important, and the question as always is, do we hold that level? If we do break it, the question I think becomes, do we follow through? You'll find a lot of times that when you have a support or resistance level, the break is one part of it. The follow through, the confirmation, the validation, sort of confirming that breakdown has legs, or that there's more downside momentum is really important, because a lot of times you'll break a support level but then rotate back above there. And you found that with the 50-day moving average and the S&P 500 a number of times in the last 12 months, where you've closed below it or traded below it but then rotated right back above it the next day. And those are breaks that really didn't have follow through. You really didn't sustain the initial breakdown. That's what I would be looking for now as we test the lows from December. Do we hold those lows? That pink shaded area is around 4550. The early December low is around 4500. Not too far below that, the 200-day moving average around 4425. We haven't been down to the 200-day moving average since early 2020. That was that February, March 2020 sell off. Obviously a pretty significant run when we broke the 200-day and a lot of other support levels on an extended move lower. Right now, it's do we hold support? So right now, I think 4550 remains a key level. We've now closed below it. Do we hold that? Tomorrow would be an interesting day if we trade back above that and we don't see follow through. That's what I'd be looking for in the remainder of this week. Now, a lot of different themes to talk about today. There's certain days on the show where I feel like I need to try to identify some charts to look at. I did not have that problem today. Sort of the cup runneth over with all the different options we could go at. But it's an interesting day, particularly if you look at the biggest winner today on the 11 S&P sectors and the weakest of the 11 S&P sectors. Sort of an exclamation point on this rotation from more risk on to more risk off. Consumer staples, the number one sector today, with the XLP up almost 0.7% on the same day. The consumer discretionary sector, the XLY, down 1.8%. That is making this ratio, which is my offense versus defense ratio, really rotating in a position of weakness. If you look in September, October, November of last year, you saw this ratio moving higher, and it told me, even though that the indexes were choppy and you're sort of going through a rotational period, this ratio is still going higher, which told you on average it was still offense over defense. That's a fairly healthy bull market sort of move to have. Look at what's happened in the last 6 weeks here. Really, since the end of November, you've seen this ratio rotate lower on a cap-weighted basis on the top panel, the equal-weighted basis on the bottom. So when this ratio is going down, that tells me that investors are leaning more into things you need versus things you want, or the relative safety of consumer staples versus the relative offense of consumer discretionary. That is not a risk on, step on the accelerator type of bull market phase. This is more of a risk-off cautionary phase, as particularly institutional investors most likely rotating to more of the defensive side of that relationship, looking at the consumer space and where we're allocated there. So consumer staples outperforming, not a great field. The second best performing sector today, utilities, and utilities is an interesting one. I find people only want to own utilities if they're trying to hide out, right? It's not a sexy sector. There's not a lot to be gained there. There's usually a healthy dividend component, but these are not high volatility, high beta offense types of names. You buy utilities if you want to ride out some market uncertainty and have a pace of relatively low volatility and stability with which to ride out a choppy market. And that's where we're seeing the two sectors up today, staples and utilities, fairly defensive. The more offensive stuff, consumer discretionary down almost 2%, financials with a lot of earnings this week. And we'll dig into some of those particular charts a little later in today's program. Down 1.7%, technology, number 3. Just to finish off our market recap, I just want to hit on some of the FANG stocks, or what I usually call the FANG man names, or fan mag names. I guess there are a number of acronyms we could use. Alphabet or Google might be one of the better ones to look at. A lot of these names are at the lower end or breaking down through support. Netflix and Amazon come to mind. I think Alphabet might be a really good chart to be paying attention to here. Besides the chart of the S&P, what are these individual names telling us? Alphabet is telling us that we attempted to go to new all-time highs in November. We've then pulled back from there. A number of times we've tried to get above $3,000 a share and have failed to sustain any break above there. So we've met resistance, and it has been it's been too much for the buyers to overcome. Now we're at the lower end of this range, and we're testing the October low, which is around 2650, 2700, we'll call it, sort of this low here. We are now bouncing off of that same level and also the 200-day moving average. And the reason why I think this is a key chart to watch is one of two things happen. We hold the 200-day, we hold this level of support, and this painful drawdown we've seen over the last 6 weeks is just the latest drawdown before we resume this market uptrend. And if that would happen, the S&P drawdown that we've had so far, pretty normal for 2021, and this would be reloading for the next move higher. However, if charts like this fail to hold the 200-day, fail to hold their swing lows from last fall, all of a sudden this market can look from a brief, very buyable pullback to a almost disastrous pullback or a corrective pattern with much further downside potential. Really good time to brush up on your Fibonacci retracements if you're trying to identify some levels of support below current levels. We need to take a quick break. We'll be back with today's guest, Llanes. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. Thanks so much for joining us every weekday after the close as we debrief on the market activity using technical analysis and the StockCharts platforms. So many times when I feel like the lessons of using charts are very palpable, they're very real, and I feel like this is one of those. I learned technical analysis really in the early 2000s when I was introduced to it, and I loved the focus on investor psychology, but I particularly loved the focus on risk management. I think we might be one of those times when it's important to pay extra attention to the charts. A couple quick comments before we get to today's guest, Llanes. First off, our questions that we receive from you are so appreciated and so welcomed. We'll have another mailbag segment at the end of this week on Friday's show, and we'd love to answer one of your questions on the air. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We're on YouTube. Put a comment below the video you're watching on our StockCharts channel. We'll gather all those questions. Hope to answer one of yours on the air on our next mailbag segment on Friday's show. Also, go to StockChartsTV.com. That is our on-demand platform. If you missed any of our market outlook specials this week, we had our Charting Forward 2022. Last week, we had Martin Pring sitting down with Bruce Fraser. We had Larry Williams with his market outlook. So much great content to help you prepare for this year, which is already starting out to be pretty exciting. Go to StockChartsTV.com. You can use your email address to set up a free account, or on any of your mobile devices, just search for StockCharts TV on demand. I want to welcome on today's guest, Louis Llanes. Louis is the founder of Wealthnet Investments. He's the host of the Market Call podcast and author of the recent book, The Financial Freedom Blueprint. Louis, good to hear from you. Good to have you back. Happy New Year and welcome back to the show.
Happy New Year. I'm so glad I'm on today of all days.
I appreciate that you're saying that. When the market gets really choppy, I'm wondering how you feel as a guest coming on the show. But thank you for being excited about it, because certainly a choppy day, right? We're finishing pretty weak into the close.
No, listen, I love days like today. The reason why is, I'm like you. I've been in this business over 2 decades, and we earn our money in periods that I believe we're about to be heading into. And so, I'm looking at this market and saying, look, there's all the classic signs that you need dry powder. You need to be preparing for opportunity, not the other way around and pushing the pedal right now. And I'm just going to, I really want to kind of talk a little bit about that today, if we can.
Absolutely. We're looking at your chart of the S&P 500. Put this into proper context, what we're seeing so far year to date. What are you seeing on this chart of the S&P?
Well, that context is exactly what I was trying to come with in this chart. If we go back to the peak in the S&P before the pandemic back in February of 2020, we kind of had a little bit of a reset, right? We came down and we had a kind of a reset with the trend. That little graph that I have below there, it's WNI trend absolute. That's a proprietary trend indicator, and all it is it's a multi-time frame trend indicator. So it looks at different time frames to see where the trend is. And there's 5 different time frames. When you have a 5 on there, that means all the trends are hitting on all cylinders. So we've been on all cylinders for a long time without very little pullbacks. And the chart below, or that little graph below, has the realized volatility. That's the actual volatility we're seeing, not the VIX, but just the actual volatility. And I like to measure that with an indicator called APR, or average percent range. That just compares the daily true range compared to the prior day's close, and then to average them out. It's a good way to kind of see what's going on. That bottomed out in September of 21. And typically when you see a long extended bull like this with this type of action and volatility bottoming out like that, you're generally moving into 1 or 2 phases, either chop, lots of chop, or downtrend. And last time I was on here, I thought, I said the same thing, and we did get the chop, didn't we? Now we're getting a potential breakdown. The leaders are breaking down now. We're starting to see, like you brought up Google. So you have to play a little bit of different game now.
Now, the S&P obviously chopping around. When you think of volatility, we also have to think about cryptocurrencies, which tend to be elevated volatility, a lot of movement. Talk about Bitcoin and what that tells you about this overall market.
I like to use Bitcoin as a really more of a sentiment indicator. So what I've done here is I love to risk normalize. And that's basically saying Bitcoin is about 5 times as volatile as S&P. Let's normalize them together so we can compare them. And so I normalize Bitcoin to the S&P, and you could see when Bitcoin, which is that top chart there in blue, when it peaks out, that's an extreme level of kind of risk appetite. People want to take risks. And what you'll notice is after those periods, the market tends to go sideways in the S&P 500 or even go down. And we're actually experiencing a double top in that now. And that to me is just one more little sign that says, hey, risk off, maybe the next move here.
Interesting, sort of a downtrend in risk appetite, or in speculation, maybe another way to put it. Now, one asset class, as it feels like everything's rolled over, gold really starting to emerge. And gold stocks certainly started to show signs of life. What is the chart of gold telling you?
Now, these are the gold futures here, and I just wanted to point out, like on a longer term basis, we have kind of a coiling pattern of volatility contraction, and it's coming to an apex. So we'll have some resolve there, but based on all the other trends in the intermarket analysis that surrounds the whole market right now, one could really make a case that that's going to resolve to the upside. And if you just do, typical normal measured move type analysis, we're looking at a move of a couple hundred points or more up in gold, which is a nice move. So, but if I could just, make it a more high level, what we're doing right now is we're trimming stocks that have run up and, have shown signs of exhaustion. We're buying more of the quality dividend plays like we talked about last time I was on, and buying more non-correlated hedged inflation hedges taken a more targeted approach in international stocks, because international valuations and some of the charts look great there, and people are kind of ignoring that. It's time to get a move for us. It's time to move out of those names that have already they've run their course.
Yeah, it's such a great point you mentioned. I'm glad you mentioned non-U.S. Stocks, Lewis, because certainly I think a lot of investors have been ignored with how strong the dollar has been, up until 2022, really the end of last year. It's been hard to think outside the U.S., but potentially that's starting to change, and you're starting to see that play out as a tailwind to gold as well. Lewis, we have to leave it there. Listen, I really appreciate you coming on the show. Thanks for sharing a couple charts that really help put things into proper context. And congrats again on the new book and the podcast. Keep up the good work. We'll talk to you soon.
Thanks a lot. Take care.
That's Louis Llanes. Louis is the founder of Wealthnet Investments. He's the host of the Market Call podcast. I had a blast going on there last year with Louis. I encourage you to check that out. And he authored the book recently, The Financial Freedom Blueprint, which is really well done. Some of those the comments he made over time, thinking about Bitcoin as sort of a overall a measure of risk assessment, is a really interesting way to think of it. I've talked about Bitcoin as sort of a proxy for speculation, because you think of market participants and why and when they are taking positions there, adjusting it for volatility to make the charts line up a little better is a really interesting way to do it. I thought that was a great way of trying to put that into context to think about stocks as well. Great take there from Louis Llanes. Let's continue on today's show. Our next segment is called The Bottom Line, thinking about our earnings season. So we're sort of in the getting into the meat of earnings. We have a number of companies that have reported. I just want to look at some of the charts that are top of mind as we go through those earnings releases. I should note, I usually use my Stock Traders Almanac, edited by Jeff Hirsch for a number of years, and Yale Hirsch, his father, who first came up with it. And there are quotes in there every day. And I wanted to share today's. If you don't have it in front of you, the quote today is from Ronald Reagan. An economist is someone who sees something happen, and then wonders if it would work in theory. I love that. Oh, it's so good. I love how, if there's technical analysts, I guess we can make fun of economists. That's good. The highest form of humor is making fun of yourself. So there you go. As we look at some of the names that are reporting, I'm initially thinking of banks, right? And charts like Goldman Sachs and others showing some weakness. And, Goldman is a really compelling chart when you think about this rotation out of some of the stocks that had been working. Goldman had a really good 2021. For the first half of the year, it's where you saw the bulk of the outperformance. And while it continued to drift higher into the second half of the year, most of the gains really were coming out of the October, November 2020 breakout, right? So everything broke out. This is when the cyclicals really were leading into sort of May, June, and Goldman sort of kept up okay with the market. But this is when a lot of the growthy stuff really started to work again. The FANG stocks started to emerge and rotate to the upside. Goldman hit about 420 and really never was able to follow through much beyond $400 a share, right? If you look at the chart, now all of a sudden though, we bounced down to the lower end of that range. And I think this was Friday's session. We kind of bounced off of or reached the 200-day moving average, similar to what we did in December. We had our earnings Tuesday before the open, gapping lower on disappointing earnings and continuing to push lower into today. So, you're not really getting any sort of bounce off of Tuesday's gap lower. You're getting further distribution, breaking below the 200-day and breaking below that level of support. I think was a pretty negative sign for Goldman. Oversold right now, and usually when you have something that's oversold, all that means is it's gone down a lot. Doesn't necessarily mean a bottom is in place. And an example of that is certainly in late February of 2020, right? We became oversold. That was just telling you that stock had gone down a lot. It continued lower for the next couple of weeks. So just because the RSI gets below 30, unfortunately, isn't enough, I don't think, to tell you that the stock is bottoming out, but it does tell me to start looking for signs of support, signs of significant bounce. Any sign of buyers coming in, you're not seeing buyers come in today. You're seeing further distribution. With a lot of these charts, by the way, I would encourage you to use Fibonacci retracements and take the low from March 2020 or whatever level might make sense to you. Take the recent highs from last fall, and that can give you some identify some lines in the sand potentially moving lower. You had some other financial stocks reporting yesterday, and we'll go through those very quickly. Schwab, maybe a bit of an outlier, because actually holding up pretty well. It was overbought going into their earnings release this week, holding up okay, and it's pulling back a little bit, but still the trend is very positive. So compare Goldman Sachs chart number 1, where you're breaking the 200-day breaking support, versus something like Schwab, which is actually holding up okay. This might be an interesting time within the financial sector to differentiate between the stocks that are still working, the stocks that are holding support and maintaining that positive trend, versus the one that are failing and starting to pull back a little bit. We had PNC report this week as well, and so far not doing so well. However, again, still holding up okay. And I would be looking at previous support levels, particularly the 200-day moving average, around 193 right now. Holding that, stocks that are able to hold that, I think, are still pretty encouraging. Stocks that are breaking those levels could be a cause for concern. We did have a JB Hunt report after the close yesterday. This is a trucking company, and those names actually have been pretty interesting. It's interesting on this particular stock. While it's been choppy, it doesn't feel like there's been a big reaction one way or the other. Look at how the relative strength is holding up so well. It's interesting in an environment like this, when the market is starting to roll over, when you're seeing previous leadership names, particularly growthy stuff, things like technology and consumer discretionary, roll lower. This is dragging the benchmarks down because there's a lot of market cap in those sectors. But something like JB Hunt, just by the fact that it's not going down, is going to outperform pretty well. And charts like this can be really compelling in a period of market dislocation, right? Stick with what's working on a relative basis if you're not able to be in things that are gaining on an absolute basis. Other names, and again, going back to the financial stocks, Bank of America, BACMS, Morgan Stanley as well. And again, some of these names are holding support. I think Morgan Stanley is an important one to watch here because it's sort of like Goldman Sachs before the gap lower. My real question on a chart like this, can it hold this support level? So you have around 95, which are the lows for a number of times, September, October, November, December. We're once again sort of hitting that level, but now the 200-day moving average is support as well. The 200-day has served as support for the stock a number of times in the last couple of years. I'd be very interested to see if that's able to hold. Now, outside of there, just after the close today, we have charts like UAL. UAL is actually selling off into the close. We can look very quickly to see how things are trading in the aftermarket. And as a reminder, during earnings season, it's a really good time to use the symbol summary function. So if you're looking at a chart, just below there, you have this link that says symbol summary. This will show you the after hours trading if it's available for that particular ticker. So I haven't looked at the earnings release or the particular text of it or anything, but I can see that the stock is holding up okay. You don't have a big sell-off afterwards. So sold off going into the close today, trading down about 2.5%, 2.6%, but not really going any further down after the close today, which is could be encouraging for a stock like UAL. That's all the time we have for our segment, The Bottom Line. As a reminder, the symbol summary page is a really good way to gauge trading, particularly after the close, if you're looking for after-hours sessions and how a stock is trading relative to its earnings release. We need to wrap today's show. Go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the S&P 500, and we're looking at 2 breadth indicators. I wanted to highlight the percent of stocks above their 50-day moving average. Andrew Thrasher joined us on the show yesterday, did a great job talking about some of the breadth conditions that are getting less and less constructive. This is an important one that I like to watch, and as long as it's above 50%, things overall are not that bad. When it gets below 50%, that shows that you're starting to see some distribution, not just in the major averages, but on a lot of individual names, because this is an equal weighted measure of how many stocks are above their 50-day moving average. If you look, previous pullbacks, significant pullbacks, have had this condition where the indicator goes below 50%, but also some much deeper drawdowns usually start this way. So I would imagine, given the weakness that we saw going into the close, this isn't updated yet for today's close. I would assume it goes below 50%, which means big red flag, an important chart to watch. Chart number 2 is Home Depot. A number of names obviously failing to hold their 50-day, breaking below swing lows from last fall. In Home Depot's case, the low from around 380 from mid-December. A lot of these stocks are nearing Fibonacci support. Here I'm taking the low from March of 2021, taking it to the high in early December, and you can see we're right there. A lot of these stocks that have pulled back are right at those first Fibonacci levels, which means this could be the time when buyers come in and provide a little bounce. It also means if those levels fail, this market can look very negative very quickly if support levels are unable to hold. When I talk about support levels not holding, I'm thinking of charts like Goldman Sachs, which is our 3rd chart today. concerned about the misses that we're seeing in the financial sector. Stocks like Goldman Sachs selling off. This earnings report, this earnings quarter could be a catalyst for charts like Goldman Sachs to improve. We're not seeing it play out that way so far. Folks, that is our show for today. Special thank you to Llanes from Wealthnet Investments joining us from Colorado. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.